Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Last week was a tumultuous one in the market. Most assets started out fairly bullish, with the Dow at a record high on Wednesday. The very next day, however, saw bond yields spike. On our previous show, we talked about the one factor that could derail a current uptrend: a rise in interest rates. This thesis is materializing faster than expected. As the U.S. 10-year Treasury yield surged above 1.5%, investors started to worry. A higher cost of capital will inevitably lead to higher interest costs and mortgage bills. Already, long-term mortgage rates in the U.S. appear to have bottomed out and started retracing their previous levels. The 30-year mortgage rate, for example, is now back to 3% after touching a historic low of 2.65% recently. Where's the end for the decline in bond prices? Hardly anyone thinks that the upswing in interest rate is over. Warren Buffett, in his latest annual shareholder letter, predicts that fixed-income investors worldwide face a bleak future. And as the world economy gradually emerges from the pandemic, interest rates are likely to normalize further. That is, it will rise again later this year. This brings us to one interesting point. Which equity sector will do well in this environment of rising rates? One industry that we have in mind is the financials. Banks typically make money by lending long and borrowing short. If they can borrow near the Fed funds rate at 0% and lend out at 1.5 to 2%, they make a decent amount of money over time. And the steeper the yield curve, the higher the return for lending institutions. That's why investors buy the financial sector aggressively when rates are rising. Look at the iShares Financials ETF, XLF. This $1.6 billion ETF tracks the Dow Jones U.S. Financial Index, holding about 231 financial stocks, and has caught a lot of traction lately according to Trackstar IQ, our proprietary search tracking tool. Prices of this ETF have rocketed recently and closed last week at its highest level ever. What is more interesting is that this ETF just punched through its previous major cyclical peak, a peak going back all the way to 2007. Most astute market observers will tell you this: when prices of a major index overcome previous secular peaks, you better pay attention, because something big is happening in that sector. By surpassing its 2007 highs, it appears that the '08 financial crisis is finally over. Wall Street's bad days are behind them. No more sector-wide litigation or massive write-downs. The financial sector is seemingly ready for a new bull cycle. Furthermore, the financial sector's relative strengths against other parts of the market is growing. Typically, you want to buy a sector that is outperforming the market. Certainly, some banks fit the bill. Have a look at JP Morgan or Goldman Sachs price charts. Both just made new all-time highs. Yes, prices are stretched to the upside, but their long-term uptrends are unmistakably bullish. However, skeptics will say that the bank's future is highly uncertain because of these three factors. One, the pandemic is not yet over. Businesses that are struggling may fail soon, creating potential waves of bankruptcies and bad loans for banks. In turn, this leads to another credit crisis. Two, the Fed may want to control the yield curve by buying long maturity treasuries. This will flatten the curve and reduce the bank's profitability. Three, old-fashioned banks may suffer from more competition from fintech, short for financial technology, companies. This will squeeze profits. And not to forget, the market may correct significantly from here. Banks and other financials may not be able to escape from a market-wide correction. That's all true, but I wouldn't discount the bank's positive price and relative trends at this point. You may also think that the iShares Financials ETF contains too many non-bank stocks, such as Berkshire Hathaway. Well, have a look at the KBW Banks Index. The 24-bank stock index is also flirting with new all-time highs. All in all, the recent rise in bond yields is a major catalyst for creating new financial trends. We suspect that this cyclical rate rise is just beginning. When yields increase, financials tend to benefit. This leads to a sector rotation from those uber growth stocks back to old economy stocks like banks. Have you seen Tesla's share price recently? It's very toppy. If the market were to correct from here, it's worth looking into buying some financial stocks to capture part of this rotation. That's all we have time for this week. Before you make any investment decisions, please ensure you do your own due diligence. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.